Welcome to Retirement GPS, navigated by Zenergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back, ladies and gentlemen, to the Retirement GPS podcast. This is episode 21. I'm your host, Ryan Zaharchek, certified financial planner and president of Zenergy Retirement Planning, and I'm here with my co-host, Mr. Zane Belsack. What's up, Zane?
Hey, Ryan. It's always good to be here. It's honestly a very nice day. Very nice day.
Nice day after a series of not so nice days.
Exactly. That's always great to see.
Absolutely. Sun out. It's not below freezing. We're in good shape. But today we're going to talk about tax loss harvesting. We are starting a little bit of a series on tax strategies. So we want to dive into our first strategy for the end of the year, which is tax loss harvesting, which really should be done this time of year. And we're going to dive into what it is and why is it important for you to even consider in your portfolio. So tax strategy is exciting stuff, right, Zane?
It is. And why are we doing harvesting in the winter, in December? Shouldn't this be a fall type of thing?
Good one. Yeah. Harvesting is a fall type of thing, but when it comes to stocks, bonds, and portfolios, it is the winter. So let's dive in and talk about what it is and how it works. Essentially, what we're going to cover today is the basics of tax loss harvesting and how losses within a portfolio are used so that we can actually offset gains and or take some losses against ordinary income. I want to explain the importance of the washout rule and how that comes into play and common mistakes and pitfalls to avoid, and how the strategy really fits into a disciplined retirement plan. And I promise you, by the end of this episode, you'll understand how tax loss harvesting turns a short-term market decline or a diversified portfolio into long-term planning flexibility, really without changing your investment strategy. And lower taxes is always a good thing when it comes to not paying as much to Uncle Sam.
That's always good to hear.
Now, what we're doing around the office this time of year is we're doing our tax loss harvesting. Now, how does that work? It works specifically for a taxable brokerage or investment account. All right. So if you have an IRA, a 401k, a Roth IRA that is either tax deferred or tax free, this is not the strategy for you. But if you do have a brokerage account, a taxable investment account, then you're going to want to look at tax loss harvesting. Now, why it works is because if you're investing your taxable investment account, the way we recommend and the way we do it here at Zenergy, is you have what we call diversification, right? So you have different types of asset classes. Some assets zig while others zag. Very rarely do all asset classes in our portfolio go up and go down in the same year. It does happen, but it's pretty rare. What do I mean by that? It's very rare that both stocks and bonds have a good year at the same time. Very rare that real estate and gold go up and down at the same time. If you're properly diversified and everything in your account is doing well, then not only that's either a really rare occurrence or maybe you're not properly diversified. So what we look at in a taxable investment account, and in the example I'm going to use of John and Jane Smith, John has a taxable investment account that is in his own name and it's worth $1 million. And he has 8 different funds that we've hand selected so that they provide diversification. Some are stock funds, some are bond funds, some are real estate funds, and some are cash funds. Now, some funds do really well in years where the economy is doing well. And some funds maybe not so well in years where the economy is doing well, which would be things like the bond funds potentially. The opposite is also true. In a bad year when the market's going down, the stock funds may not do as well, but that's also typically coupled with a cut in interest rates because the Fed is trying to stimulate the economy, trying to improve things in the market. And by doing that, the bond funds are doing really well in the same year. And each year at the end of the year, we typically wait till December. We take a look at how are these various funds performing. Are they up or are they down? Essentially, since we bought them, are there capital gains or capital losses in those funds? And in the case of John and Jane Smith, we'll go into their account. We'll take a look at each of their individual funds, and we'll see, do they have gains or do they have losses? Some funds may have losses. Most likely they will, at least in the short term. We can then sell those funds recognize the loss, i.e. harvest the loss in December, even though it's cold out, we're harvesting losses, and we're able to then take that money and roll it into a slightly different but materially similar type of fund so that we can reinvest it. We don't miss out on our investing strategy, but we're also recognizing those losses in the year that we do it. So for 2025 in December, if there is a bond fund, because interest rates have gone down, so bond funds are doing pretty well. But if there was a bond fund that was losing money because we happened to buy it in 2022 or something along those lines, we could recognize that loss in 2025. If it were, say, a total bond index, we could then turn around and go buy, say, a U.S. government bond index. Not exactly the same fund, has very similar characteristics, and we're fully invested, so we keep ourselves fully invested, but we're recognizing a capital loss, which would be really valuable to us.
So it really just sounds like you're taking advantage of the loss, but then just going from one fund to a eerily similar fund. That sounds about right?
Yeah, very true. What we want to try to do is find another fund that's got a high correlation to the first fund. It's going to be materially different enough that the IRS recognizes that it's not the same fund. In the case of stocks, a lot of times if we have an S&P 500 fund, the S&P 500 is down on that year, we'll sell the S&P 500 fund and buy, say, a total stock market index fund or something comparable so that we can get that exposure. And really what we're trying to do is we're trying to recognize those losses to use in three different ways. The first one is to offset capital gains. So if we do happen to have any capital gains in the year, the losses will offset those gains, which is fantastic because in $1 million account, let's say we had 20,000 in gains that year, we could take 15,000 in losses, they net out, and now we only have $5,000 that we're paying taxes on in gains, simply because we had this fantastic strategy that really didn't affect our investments or our performance, but allows us to harvest losses. Second, we can also then offset $3,000 of ordinary income. So if I have this $1 million portfolio, but then I'm also making $200,000 a year, if I actually have more losses than gains in that year, $3,000 can be used to offset my ordinary income. And if there's even more than that, I can carry that forward to future years indefinitely. So those are really the three benefits of taking those losses and things that we can do with those losses. Just to be clear though, this strategy only applies to taxable accounts. As I said, I want to reiterate, this is not for IRAs, not for Roth IRAs, and certainly not for 401ks or employer-sponsored plans.
And I bet the listeners thinking probably what I'm thinking is, what's the catch? Why does this seem too good to be true?
Yeah, really there is no catch. That's why we like it so much. There's a couple of sort of minor inconveniences. The first one is that you're not able to go back and buy the exact same fund that you just sold. So we have to find a materially different fund, but they can have the same characteristics. And if you look at the correlation of the S&P 500 fund against a total stock market index fund, both cap-weighted funds, both mostly the same stocks, they're going to have a 97, 98% correlation, but they are technically different accounts. If you do want to purchase the same thing back, you do have to wait 30 days or else you fall under the wash sale rule. So we're going to get to that in a minute, but there really is no catch. It's really a free look at taking losses to offset gains and offset a little bit of personal income in a year where you've experienced those losses.
I guess the loss itself is in the name, tax loss. You're taking a loss either way.
Yeah, and what you want to look at is that I'm not actually really taking the loss. I'm recognizing it for tax purposes, but I'm not really taking the loss because immediately, as soon as I sell, say, that S&P 500 fund, and the S&P 500 is down 15% this year, immediately I sell the fund, and 10 seconds later, I buy a total bond market fund. I'm not really taking the loss because if the market recovers at 15%, the total stock market index will recover that same amount of money. Effectively, I'm not really recognizing the loss, and I'm not changing my portfolio structure and risk management style. I have the same portfolio in place, so it's important. We want to make sure that the key here is that we're staying invested while we're harvesting the losses. We don't want to sell, wait the 30 days to avoid the wash sale rule, and then invest back in, because over those 30 days, anything can happen. A lot of things can happen, so we want to be careful of that. We want to replace with a materially similar investment. If you do have individual stocks in your portfolio, which we don't recommend, you cannot go buy that same individual stock unless you wait 30 days, or else the wash out rule comes into play and the loss is negated effectively. So let's talk about the common pitfalls. The big one is the wash out rule, which we've touched on. So it disallows a loss if the same or substantially identical investment is purchased within 30 days. What is substantially identical? It means if I sell the Schwab Total Bond Market Fund and then I go buy the Fidelity Total Bond Market Fund, they're going to call that a washout. Basically, they're going to say you bought materially the same thing. Now, if I sell the Schwab Total Bond Market Fund and I go buy the Schwab 3-year government bond fund, that's not going to just trigger a wash sale. Okay, it's not going to trigger a wash sale because it is different. There's a different risk profile to that fund. It's slightly different, but the correlation is very high. But it's different enough that we can avoid that wash sale trigger. All right.
And how is that differentiation confirmed? Is that really by the name? Is that by the fund?
Yeah, the name's not going to matter. It's just the fund itself has a different investment profile. In a total bond index, let's use the stock market, it's easier. The S&P 500 is very clearly 500 specific stocks that mirror the S&P 500. You could do that within a Schwab fund. Then you could go buy a Schwab total market index, and that actually has a different profile. It's got a profile that matches the total stock market index. So those are two indexes that index funds match, and they're different indexes. They have a super high correlation. If the S&P 500 fund moves $10, the total stock market fund is going to move $9.90. Like, they have a very high correlation because what's under the hood is very comparably the same, but they are slightly different. So as long as there's that slight difference, that's what we're getting.
So it's like a car. They're both cars, but you have two separate engines.
Two different engines. They both go really fast. One is a turbocharged 800 and one is a turbocharged 850. They effectively do the same things. We just have enough of a difference that they can't be called the same. And that's what we want to make sure that we have. And we have been doing this long enough that we really have a good understanding of which funds are not the same. You really just don't go by the labels. Just because it's a different symbol doesn't mean it's not materially the same or substantially identical investment. And that's really how the IRS describes it. If it's substantially identical, meaning same investments under the hood, just a different name, that's not going to count. If it's different investments under the hood, even if they're slightly different, that's enough to say that they're not substantially identical. And what I mean by another good example is if you just had a short-term treasury bond. If you had one treasury bill, as an example, that expires in 3 months, you sell it at a loss, and then you turn around and buy it. That's probably a bad example. They don't fluctuate very much. But if you sold it at a loss and turned around and bought a different treasury bill, substantially identical, even though they have different CUSIP numbers and potentially different, they are the same thing. So we just want to be careful of that. It can occur unintentionally if you have automatic dividend reinvestment. So if you have an automatic dividend reinvestment in a fund, if it just how it happens a dividend was paid and you switched out the funds and then the old fund was bought back by the dividends automatically in the brokerage account, that can trigger the wash sale, so be careful for that. It would be a small wash sale, but it would still be a wash sale if you purchase inside a retirement account. So that's like kind of a tricky way that some people will say, I'm going to sell my NVIDIA stock in my taxable account and then go buy it in my retirement account. That will trigger the wash sale. So if that's the case, don't do that. If you have NVIDIA that you want to sell, I doubt you have it at a loss, but if you do have it at a loss, you can sell it. Just don't go buy NVIDIA. Go buy an AI ETF. Go buy a different AI stock. They're not going to be exactly the same, but you'll get a high correlation, and at least then you won't be subject to the wash sale. And then lastly, replacing a fund with one that tracks the same index, and we talked about that, just two different symbols, but they track the same index, okay? As long as you're tracking a different index, it's not substantially identical, right? They're two different indexes you're tracking. Now, the indexes could track closely together, but if you pick two different funds that track two different indexes, you'll avoid that wash sale rule. So this strategy is really most effective when you expect, number one, you expect either current or future capital gains. You know, you took some big capital gains this year, or you expect big capital gains in the future, and you've got some big losses that could offset that. Second, if you're in a moderate or higher tax bracket, obviously it's really valuable. So if I'm in the 37% bracket, which is our highest federal bracket, and we trigger some losses and $3,000 can offset at 37%, then great. That's a huge value there. We have sizable taxable investment accounts. The larger the investment accounts, the larger the potential losses because the asset classes are going to be large numbers. Triggering those large accounts really provide a ton of value. And then you value long-term tax efficiency over a short-term reaction. So you're not too concerned necessarily about switching out a fund in the short term, but you really value that long-term efficiency. And if there's a fund specifically that you really like and you want to make sure you get back, just wait the 30 days, wait till the wash sale rule expires, and then you can go back and reverse back and go buy that. When it may not be appropriate, it may not be appropriate if you're in a low tax bracket. It just may not be enough advantage there. If you're in a really low tax bracket and you have some gains, those gains may be taxed to zero anyway, so you really don't need a loss to offset it. Losses would disrupt your allocation discipline. Again, I don't really see that being the case if you have the properly diversified portfolio and you're purchasing a similar but materially different fund. But it may disrupt your allocation if you're buying individual stocks or individual investments. The portfolio is not expected to generate capital gains. You really don't need to take much more than a $3,000 loss because anything more than $3,000 is just going to be carried forward anyway. It may not be worth it in that case. And it's not done without coordinated planning. So make sure that you're including it as part of your general comprehensive plan so that we have this strategy that is doing multiple things for us all at the same time. So action steps. First of all, identify which accounts are taxable in your taxable account that actually are potential candidates for selling at a loss. Be aware of the wash sale triggers. Make sure, including reinvestments, that you're not going to be triggering a wash sale if you do take advantage of this strategy. Coordinate your tax loss harvesting with your advisor or tax professional. So just make sure that if you are working with an advisor, if you are working with an accountant, talk to them about it. Just say, here's what I'm thinking about doing. Do you see any pitfalls or downsides to doing it? And incorporate harvested losses into your long-term tax strategy. If you are able to offset $3,000 in ordinary income and you're like right at the cusp because you're doing Roth conversions, it can be really valuable to make sure you're staying under IRMA thresholds and things like that. Market volatility is inevitable. Diversification typically creates short-term losses in any market environment, even if it's a good market environment. So tax loss harvesting doesn't necessarily eliminate discomfort from the volatility, but if it's used properly, you can make sure that you're taking advantage of volatility when it does come and using it to your advantage and to your favor to reinforce that you're staying disciplined in your long-term planning and using some tax strategies along the way.
I think tax loss harvesting is definitely it's a really great tool to use. The emphasis is really just on using it correctly.
Yeah, it's basically a free look to take advantage of losses and utilize those losses to your benefit. You can't lose if you do it smart and you do it the right way. If you like what you heard today, make sure that you go and subscribe to our podcast. We want to make sure that you're getting all this great information into your inbox every time it comes out on Tuesday, and you want to be on top of that. Make sure you give us 5 stars. We really would appreciate that. Let people know about us and get more people to listen to us. And lastly, don't be afraid to reach out. If you do have any questions, you have any comments, you have any concerns, things you want to learn about, give Zenergy Retirement Planning a call, and we can talk it through with you. Be glad to help you out anyway. In the meantime, keep learning, keep planning. We look forward to next time.
Have a good week.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.